Hello from a rather dreary and rainy London, unfortunately. So I think that a few of you out there will probably be familiar with this thing called the 60-40 portfolio, which essentially for the last 40 or 50 years has served investors and traders fairly well. So what am I referring to? Well, it's the allocation, or it was at least, the allocation of choice for traditional balanced portfolios, and the allocation worked in this way. So 60% of your portfolio was allocated to equities for the good economic times, and 40% was allocated to bonds, which is more for the kind of average or bad economic times, when you'd expect bond prices to go up and yields to come in. So over this period, which is quite a long-term period that I'm referring to, equities performed best, and if you had a buy and hold strategy that where you didn't need to draw on your portfolio, then this structure worked very well, because in times of market stress you would have the bonds performing, and that would dampen the overall portfolio volatility, as there was essentially a flight to safety and yields came in. And having 40% of your portfolio exposed to bonds, for example, during the dot-com bust or the global financial crisis, that actually really helped the performance of your overall portfolio. And if you look at the way that the 60-40 portfolio performed, and in terms of standard deviations, then what you'd see is that the standard deviation of a portfolio that was comprised solely of equities was significantly higher than the standard deviation of a 60-40 portfolio, and only actually improved the annualized return by just under 1%. So in other words, on a risk-adjusted basis, in terms of risk-adjusted returns, your 60-40 portfolio performed in a much more superior fashion if you just basically bought that and held it. So why was this strategy working so well for such a long time? The main, I guess the main sort of tailwind to this strategy was that for the last 40, 50 years, we've had several kind of disinflationary forces prevailing, amongst which you've got, aging demographics, the growth of IT, the emergence of China, and of course globalization. And these things combined kept essentially a lid on inflation and allowed central banks to operate really without worrying too much about rising consumer prices or inflation. So as a result, interest rates steadily fell. Of course, as rates and yields fell, bond prices went up, and so in the main did the price of equities. So we really had, for 40 years since the early 80s, both bond and equity markets with the tailwind of falling interest rates. Now, as we start to get into almost the mid-2020s, so as I've said, we had a 40-year bull market for bonds. Where we are now, for the first time in history, US Treasuries are actually on course for a third successive year of losses, which is unprecedented. And as already mentioned, in the last year plus, what we've seen is bond and equity markets actually moving in the same negative direction. So as mentioned, what we've seen over the long term here is falling interest rates, low inflation, and low volatility compared, on a kind of historical basis, which has been a great environment clearly for both bonds and equities. But I think it's worth asking the question, might we be entering a regime change which could see these conditions change? So one of the big questions is, will the inflation genie be entirely returned to its bottle? Because once that's out, it's notoriously quite a long-term project to get that back in. And if it's not entirely back in the bottle, are higher interest rates here to stay? And therefore, does that, have implications for bond and equity returns being less positive as we progress through this decade? So, some of the current things that I'm looking at war is expensive and it's inflationary. So that Russia, Ukraine, NATO situation we know has caused policies to be implemented in the US and the EU, such as energy rebates and windfall taxes. These things don't come for free, they come at a price. There's also been an inexorable rise in defence spending, not just in the US, where you've seen an increase of almost $1 trillion per year, but also in Europe as well. And we've seen a reversal of globalisation via sanctions, embargoes, trade barriers for countries to secure their energy and food supply. This most recent conflict that's now happening in the Middle East has induced political calls for even more military spending in the US. And that conflict, of course, directly, it could be argued, threatens the global supply of oil and gas, given where it is. So, over the last 40 years, we've seen globalization and technology being very dominant disinflation drivers. Now, is this going to be the case going forward? Over the very long term, world trade as a percentage of world GDP rose from about 10% at the end of the Second World War in 1945 to a peak of 61% in 2008. What we saw over that period was essentially free movement of people, capital, goods, commodities, increased supply, reduced inflation. A lot of these tailwinds are either in the process of reversing or have reversed. Currently, we've got these conflicts that I've mentioned already, but the biggest, one could argue, geopolitical rift is actually between the US and China, which of course are the two largest economies in the world. China's economy, as we know, depends on exports, access to the Pacific, access which is now being blocked partially by Japan, Taiwan, the Philippines, Indonesia. China wants and needs free access to the Pacific. The US perceives this as a threat. Why is this significant? Because how has the US responded? Well, to their China's trade, tech and military ambitions, they've responded with trade barriers and subsidies to support reshoring to the US, back to the US, and of course the CHIPS Act. So generally, what we are seeing in this decade is an era so far of bigger government. This is also another important reason why bond yields have risen so dramatically. It's not just about the level of Fed funds, it's also about supply and demand. US government bonds are definitely not in short supply. The US government deficit in Q3 of this year was 8% of GDP. That is the largest deficit in the history of the US outside of war and recession. Government spending as a percentage of GDP is currently around 44%. Again, a level last seen in World War II. And to put things into context in terms of how big the budget has now become in the US, the size of Biden's proposed 2024 budget is so large, in the region of $6.9 trillion, that would actually make the US federal government the third largest economy in world GDP terms. This is how big government is becoming. So, is this a new investment risk that bond yields may need to rise to levels that cause greater fiscal spending discipline? In other words, will the bond market vigilantes be back? And, unfortunately, in terms of imposing fiscal discipline, next year, 2024, happens to be a huge election year where voters in countries that represent 80% of global equity market caps, 60% of global GDP, 40% of the global population are going to be voting next year. That is not a political incentive for discipline. And what I want to leave you with here is a long-term chart going back to 1791 of US government expenditures as a percentage of GDP. And as mentioned, we are now at the level of 44% of GDP. This is US government spending. And that's even greater than during the GFC. The only time it's been exceeded was briefly during the COVID period. As you can see on that chart, it's the same as the government was spending as a percentage of GDP back in World War II. We are living in unprecedented times here. And certainly I think some of these themes, which are maybe not the, what the consensus themes are, providing us with potential trading opportunities. So, there we have it.